Welcome back to the Microlearning Institute. In this tutorial we have a look at the question ACCA F7 December 08 question 4B Promoil. This question addresses some issues in the area of IAS 37 provisions, among other things. The question states that on the 1st of October 2007 Promoil acquired a newly constructed oil platform at a cost of $30 million, together with the right to extract oil from an offshore oil field under a government license. The terms of the license are that Promoil will have to remove the platform, which will then have no value, and restore the seabed to an environmentally satisfactory condition in 10 years' time when the oil reserves have been exhausted. The estimated cost of this removal on the 30th of September 2017 will be $15 million. And the present value of $1 receivable in 10 years at the appropriate discount rate for Promoil of 8% is 46 cents. And the requirement is we're asked to explain and quantify how the oil platform should be treated in the financial statements of Promoil for the year ended the 30th of September 2008. So let's have a look at an extract from both the income statement and statement of financial position. Firstly, let's consider the asset for which Promoil paid $30 million. But as well as paying $30 million, Promoil also agreed to restore the seabed. So this agreement gave Promoil the rights to the future economic benefits of the oil platform. So consequently, as it gives rights to future economic benefits, this future payment must be recognized as an asset. And IAS 16 says that we recognize any future payment for decommissioning costs at its present value at the date of acquisition. So the present value, the discount factor is 0.46, and the cost that's payable in the future is 15 million. So consequently, the present value of 15 million payable in 10 years' time is 6.9 million. So the total amount recognized at the inception of the asset is 36.9 million. And of course this happened on the 1st of October 2007. Within the year we need to recognize depreciation, and again the useful economic life is 10 years. So we're recognizing depreciation of 1/10 of $36.9 million, which is $3.69 million. So consequently, the carrying amount of the asset at the year end is $33.21 million. And the depreciation expense goes to the income statement, that is $3.69 million. In addition to the depreciation of the asset, we must also recognize interest in the period. And this need to recognize an interest expense in the period arises from the fact that we discounted the future payment of $15 million by 10 years to the 1st of October 07. So we now need to compound at the same rate, which is 8%, for 1 year's growth of this discount. So the $6.9 million that we recognize as the present value of the future payment now needs to be compounded forward at 8%, and the interest expense that we recognize in the year is $0.552 million. Of course, at year end, we also have that liability for the upcoming future payment for decommissioning. The present value of that liability at the beginning of the period was $6.9 million, and of course in the year that liability was increased by the interest that was recognized at 8%, that is $0.552 million. So at year end, the total value of the liability that we recognize in relation to future decommissioning costs is $7.452 million. As we continue to compound this liability forward, in 10 years' time, it will equate to $15 million, which of course is the amount that it's going to cost us to decommission the seabed. Thank you very much for watching this short tutorial from the Microlearning Institute in relation to ACCA F7 Promoil from December 08, question 4.